All right, we made it. And I believe we're live.
I think so.
Okay, awesome. Well, thanks everyone for joining us today. My name is Marita. I'm really excited for our discussion today about alternative financing. We have an awesome panel of speakers today who represent all sorts of different funding, like debt financing, revenue-based financing, impact grant funding, and equity-based solutions. So our goal for today's session is that you gain a greater understanding of the various funding options out there, depending on your startup stage, your revenue model, and your customer base. Plus, we'll cover a couple equity versus debt conversations. Hopefully we can get to that in our brief 30 minutes. So quick intro on myself. I'm a VP at Silicon Valley Bank with a background in working with early stage founders. I've been an operator at early stage startups, ran accelerators at Techstars, and relevant to our discussion today, I've helped startups with their crowdfunding campaigns at Indiegogo. So my role at SVB is to support founders within the greater Boston community. SVB is the commercial bank specifically designed for the venture ecosystem. So we work with tech companies from incorporation through going public or having an exit. So after this, if you're interested, would always love to talk about SVB and how we support founders and our own alternative funding options like venture debt. So you can feel free to reach out to me on LinkedIn. But that's enough about me. I'm joined by an awesome group of speakers. And since we just have 30 minutes today, let's do a quick round of intros and then get just right into the discussion. So who would like to start? John, you want to go for it?
Sure, sounds good. Awesome. Great to have everybody here, and thanks for having us to discuss alternative investments. So I spent majority of my time providing funding and advice to early growth stage companies. Worked with a firm called BDC, Business Development Bank of Canada, for 7 years in very senior lending roles, and then moved to a SaaS investment company called Lighter Capital, which some of you may know. Specialized in revenue-based lending all the way back to 2012, when fintech was not even a word back then, or even if it was very small community. After Lighter, I worked at a venture debt firm that focused on high growth, capital efficient companies based in Toronto. And most recently, just about a year ago, I joined Boast to lead our funding division. Boast is an R&D tax credit platform that operates both in US and Canada, and we help companies access to billions of dollars through these innovation tax credits that are given by Canadian and US governments. In Canada, we also fund our clients by providing the tax credit claim much faster than that, like H&R Block, and I lead that division. So I'll turn it to James.
Yeah, I'm James Turner with Fifth Line Capital. We are a financial services firm focused on early and growth stage companies, but specializing in raising venture debt for primarily technology companies. Most of our clients are in the software space or some type of technology platform. Most of the time have some sort of VC or private equity backing already, whether it's seed, Series A, all the way through Series D companies. Still cash burning, but typically looking for additional types of capital that may not be an equity route right now to avoid dilution. So we run the gambit of identifying what their capital options are, identifying the right lenders, handling the reviews. We'll negotiate and structure the terms, and then stay involved to help facilitate diligence all the way to funding. Most of the companies that we find are the best fit for debt, as far as our clientele typically range somewhere between 3 and 30 million in terms of top line revenue. Like I said, VC or private equity backed, still cash burning, and then usually between the U.S. and Canada as far as geographic location.
That leaves me. Hello, everyone. My name is Henry Noel, and I'm with Boston Impact Initiative, and we're a fund. So we're looking equally at both the impact that it has on society or the planet. More specifically, we look through an economic justice lens. So we're very concerned about the reducing the equity gap or the wealth gap between BIPOC communities and the majority communities. Specifically, what we're doing is we are providing capital at many stages to communities to Black and brown communities. And what we're looking for is really to give communities voice. We're looking at who's in charge, who owns the various businesses. We also are very concerned with empowerment of community and empowerment of workers. And we do this by providing capital to small businesses, again, with an integrated capital approach. So we're really looking at providing whatever type of capital a particular company may need, from straight debt all the way to straight equity products, everything in between.
Awesome. Thanks, everyone. So some of us may be familiar with venture debt, but there's a lot of different options out there. So maybe we could start the discussion by just talking through a couple different, maybe underutilized alternative financing options. Who wants to get started?
Yeah, I can jump in if that works. What we found is at the earliest stages for primarily software companies, that's what software companies are the first ones to be able to utilize debt, in my experience. Like I said, that 3 to 30 million revenue range that I talked about for clients that we work with on the venture debt for a non-software platform, CPG brands, business products, services, whatever it may be, we really find that closer to a $5 million revenue mark. But for an early stage software company, there are platforms like Pipe, CapChase. Those have come about pretty recently, and we found that they're a pretty attractive option for some of the clients that may be a little bit too early for more traditional venture debt facilities like term loans or lines of credit. And then they can be used to accelerate them into their next equity round and or a more traditional venture debt round.
Yeah, I would like to add to that and totally agree with you, James. Essentially, the fintech lenders, which I would consider CapChase, Pipe, Coral.io is another one, Lighter Capital as well. They focus on usually as soon as you have 50K MRR, all the way to 1 to 2 million MRR. They are 2 million ARR. They are great fits for acquiring that type of lending. I think those companies, they can still support you in a long term, but again, some of those facilities, the type of facilities may not have the flexibility of a line of credit or some of the more senior terms that a bank would be able to offer at a much attractive interest rate as well. When it comes to the underutilized vehicles, I would also add, being obviously a little biased, the tax credits are a big one. In Canada, the program has been around for about 25 years, and it's very similar to the program in UK and Australia as well. And it's one of the pillars of the innovation economy. In US, in 2015, with the act that was passed, tax credits became a highly sought after topic, and the program is still improving, but based on the innovation projects that the companies are taking, they are essentially qualified to apply for some of these payroll tax offset credits, which are as good as cash. As long as you have employees, you are paying payroll taxes to them, right? So those are very early stage facilities, and then you get your online tech lenders like Lighters and CapChase and Pipe, and maybe we can touch base on the different variations of those, and then you get the more senior venture debt solutions like James and Fifth Line offers in terms of consultation and finding the best suitable option.
Henry, anything to add maybe on the impact or the grant funding side of the house?
So we don't so as far as grant funding, what we do is a lot of times grants, the timing between a grant being awarded and a grant being received are quite different. So we do a lot of lending in the line of credit aspect, where we try to facilitate or try to bridge that type of time frame and the requirements there. In addition to that, what we've seen is that a lot of the companies that we're investing in are not necessarily your high growth flyers and don't have that hockey stick trajectory. And we're seeing some companies that are more on the meat and potatoes side of the table. And with that type of growth profile, we're finding that something that works very well for them are equity investments, but with a structured exit. So where we'll predefine a predetermined exit in year 3, 4, or 5 after we've identified that the company will cash flow at that point, and then we can assign it a particular IRR that we're targeting for that time period. So that typically works pretty well for some companies that are not quite ready for debt at that time, but it is an equity product where we have a predetermined exit.
Super helpful. And before we move on from this topic, I would be remiss not to mention it. So I used to work with the Air Force to work with early stage startups in partnership with their innovation arm called AppWorks. And I was kind of blown away by how much money the government is willing to spend on working with early stage startups. So if anyone in the audience is building a frontier tech or dual use product, I would love to talk about how those types of funding grants work. The SBIR process is fascinating, albeit really hard, but always interesting. So let's move on a little bit. I would love to kind of talk some sort of tactical tips here. So say I'm a founder, early stage, I'm a seed founder. I found a pathway to financing my startup, but I'm not really sure where to start. So does anyone have feedback on where would be a good place to get started?
Yeah, I can take a stab at it. I mean, essentially, if it really is somewhat determined by your pricing and business model. Like if you are a SaaS company, there are no shortages of, funders out there that want the SaaS companies. And with that being said too, you can go to each lender directly and have a quick submission form. And the SaaS investors have become so efficient that after one or two phone calls, they can issue a quick term sheet, right? And again, it will be a non-binding term sheet, but at the end of the day, it will have the blueprint and the outline of the financial covenants and the terms that you may be able to consider. Because ultimately, the most prominent SaaS lenders out there, they connect to your QuickBooks and your bookkeeping directly, and that's how they're able to act very quickly. That would be a one method. Or I would say that the capital advisory firms that are always happy to connect you with some of the investors, and instead of going through the process with 7, 8, 9 different lenders or investors, you get to deal with one, and they bring you the best term sheet, and they create a bit of a bidding process, which James can probably alert you into.
Yeah, thank you. So we talk to, I'd say probably a third of the companies we talk to every month. They're just too early, revenue wise, or they had some real fundamental issues with the business they're still recovering from, whatever it might be. So talking to someone who does know the market, that there is value in that, because even if they tell you, hey, you're not here yet, like for example, we'll tell them, hey, go to Pipe or Cap Chase for now. Based on what you're seeing, let's talk in a year. So it is valuable to know where you sit in the market. Our whole value prop when we're talking to prospective clients is just as valuable to, someone that we could never work with, is that, look, we know the market. You may not like what someone has to tell you, but it's better to hear that in one phone call than spending hours, days, sometimes weeks on a bunch of phone calls and emails just to find out the same thing.
I'd like to add to that the idea of prospective entrepreneurs need to know their target market and understand who the target investor is, who invests in your company and companies like yours, in your industry and at your stage. Very, very important, so that you're not using a spread shotgun approach to try to hit a wide group of people. Instead, be real targeted on understanding who are the players and investors in your market, and reaching out to them specifically for not only potential investment, but also insight into, again, as James just mentioned, who else may be active in that space at that time. As an example, we are an impact investor, so we're not looking at every type of investment or every type of entrepreneur. Understand what it is that particular investor wants, and what their lens is, the particular lens that they may be focused on.
Anything else to add, John? I saw you come off mute.
Oh yeah, I don't think I ever went off mute, but went on mute. But yeah, I mean, essentially, I would say keeping a short list of. I mean, if you search SaaS landing, you will find essentially everybody that shows up on the first page are the prominent players. The rounds that are led into these companies correlate with how high they rank on Google search as well. And they are great at it, right? So I would say keeping a short list of these players. And also, you have accelerators, Techstars, and SVB startup services. I mean, there are a lot of ecosystem players out there that can direct you in the right direction to find available capital sources as well.
Wonderful. Maybe that's a good transition into kind of talking about the different types of options for the different stages of companies. So would you all kind of be open to chatting through idea stage? What are the options there versus maybe you have a multi-million-dollar revenue venture funded startup? What does that look like?
Yeah, Henry and John, you might actually, you're definitely much more qualified in the idea and launch phase than I would be.
Yeah, I would say, Henry, would you like to go?
That's fine. You can start.
Oh, okay. Yeah. So most of our clients on both side or even lighter capital side, it was mostly seed to Series A companies. I mean, later stage between sometimes Series A to Series B companies, we used to issue term sheets as lighter capital. And also you do get a lot of companies that are bootstrapped that have never had any of these raises and they are growing through maybe some corporate venture investment or convertible debt, right? Like, so not every company needs to fit into that pathway of the seed to post seed, Series A, Series B, right? We are getting, as what I find as entrepreneurs are becoming highly sensitive to dilutive options out there. They are actually looking at growing through their own MRR that they are generating. And like we mentioned earlier, the cap chase and pipes are actually enabling that growth as well. So that when the company goes to do a Series A round, they don't have to give up that much equity because they haven't lost anything along the way, right? But I would say that for most early stage companies, tax credits, grants, any kind of government program and MRR loans, revenue-based financing options are kind of bridged until you get a more senior lending option.
I would definitely echo what John has mentioned as far as first looking to the money that's cheapest. So grants, things of that nature. A lot of companies that we've seen also have gotten money through different prize competitions, accelerators, and things of that nature as they're building up their business, as they're getting to through the pilots, as they're really building out the true business methods or the true methods of their business, the model of their business. Revenue-based financing we found has been very instrumental as well, and very key for some businesses where it definitely helps them as their business is fluctuating, the revenues are fluctuating in their stage. They are able to handle the payments that come with the financing that they're getting. So very key to a lot of businesses as well. For us, again, we will look at some very early companies. However, I do intend to encourage them to, again, find what monies you can through the grants, and especially since we're looking at companies that are looking at making an impact, they are very much socially aligned with a lot of grant providers. So have those as key areas that you're looking to address first, and then we will definitely look down the line at, after you've met a few metrics, getting into some investment products.
Yeah, to add to that, I would say a lot of it depends on what the business is and what your goals are. I've talked to founder and CEOs of companies generating $20 million a year. They own 99% of it. The other 1% is early stage employees. It took them 22 years to get there. I've talked to companies that, they need to grow fast. They need to hit the ground hard. They had to sell off, 10, 20, 30% ownership in their business. But as a result, they're able to hit that $10, $20 million revenue mark in just 4 or 5 short years. So I would say that definitely is a factor. The piping cap chases, I'd say, are probably fairly comparable to as far as stage fit as like a lighter capital revenue-based financing option. We find once companies hit that, call it 200,000 or so in MRR, that's when more traditional, much more scalable venture lending options come into play, where you have a traditional term loan, line of credit, and a lot of those guys, they don't care how much capital you've raised. They want to make sure that if you're burning through cash, there's a backstop there. But all in all, I'd say probably a third, if not 40% of our clients of all different stages haven't raised much, if any, venture backing, which is really where we are able to differentiate between, SVB, WTI, things like that. There is a subset of market that's growing quite a bit that they don't, like, Henry was saying, you don't want to dilute anymore. They're willing to pay, 8, 10, 12, if not even more on an interest rate if it means they retain that ownership in their business. And that's at all stages.
Yeah. James, you've really hit on the two dilemmas of either bootstrapping or taking on VC debt. I would just love to hear, Henry and John, your perspective on when it makes sense to go after equity versus debt.
Well, the first thing I'd like to say there's some entrepreneurs, not all, don't fully understand the idea that equity, though you're not paying on it regularly right now, immediately, is more expensive than debt. And it's important just to get that out there so that we understand that if you can get debt, a lot of times that may be depending on circumstances, more appropriate or cheaper for the company. Let's start it that way. So and typically with regards to debt, there are others on the panel who are more qualified than me as far as some debt products go. But it's really, when you have the ability to cash flow and you're able to service that debt, then you're able to get into some debt that before was not available to you. So other than that, sometimes it is that you have to take on equity because that's all that's available to you at that point. But bootstrapping, as long as possible to the point where you are not being diluted too much, is typically a good strategy.
Yeah, absolutely. I mean, it's funny, right? Like I spent majority of my career talking about debt versus equity, and what I've really pivoted into in the last couple of years, it's debt and equity. It's not versus. I mean, there's no question that in early years of a company, you're going to have to raise money from angels and friends and family. And then after that, as soon as you start generating 50K to 100K MRR, you have options that start unlocking themselves for you, right? Like as we mentioned, and it's really not about one or the other. It's about how do you want to complement your cash flow until your next equity round. And none of these players, other than cap chases and pipes of the world, they also don't want to be called bridge financing options. Because they have had success stories with companies that have been able to grow with frugal, scrappy financing facilities, that they don't want to just bridge you until the next round. Because when they look at your financial statements, they want to see that growth is there. They want to see the high gross margin is there, and you can have burn. I mean, most SaaS lenders are okay with having a net burn of 50% of your monthly revenue, but it also has to be slowly declining as the revenue scales as well, right? So I would say that once you kind of hit that impact window for some of these early stage lenders, there's no question that equity will come along the way. But I think it's not that or this. It's really about educating also your equity providers on the fact that as a founder, you like that, because most of the time, the reason that companies exit from SaaS investor portfolios is because they do an equity round and then they get their debt facilities buyout, but then a year later they are shopping for another debt facility again, right? So I think it's really about optimizing your the weighted average cost of capital on equity and debt, and trying to lower it as much as possible to lower teens, probably, because I think the equity cost could be argued anywhere between 20 to 35%, right? Where with some of the early stage lenders, if you are non-VC sponsored, you can go as low as 13%. If you have VC sponsors like Hercules and W2I, you could go as low as 7-8%, right? So it's all about, I think, optimizing and not choosing one or another.
That's wonderful. James, anything else to add there?
No, I think that all makes sense. And the irony of the cost of equity is the more successful you are, the more expensive that equity actually is. We talked to one founder last year. He averaged out his cost of equity was 71% annually because he was growing so quickly. So he was definitely someone that was willing to pay 10 to 12% on an interest rate for a loan.
Wow. Wow. All right, so we just have 5 minutes left. I want to make sure, it looks like we have one question in the Q&A, but before I get to that, the three of you have brought such awesome answers here, lots of knowledge share. What is the best way for people in the audience to work with you if they're interested in learning more about what you do?
Go for it, John.
Yeah, just you can simply reach out to me through LinkedIn, and we can share contacts. I believe it is my LinkedIn handle is included in the profile. So feel free if you have any questions about fundraising and any of the players that we mentioned on the call. Happy to introduce you to them as well. Yeah.
Yeah, for me, same thing. LinkedIn, my company's website, I believe, is in the profile. Also, we also work with companies at a pretty early stage, and kind of getting them ready, type of financial services, get them to the point where they have the metrics, they have everything ready to go raise debt, either now or down the road. So I always have to talk with someone, let them know, what, if anything, might be a fit.
As everyone has said, my information is in the profile, and I think that we are relationship type of investors. We really put a lot of stake into the relationship that we've built with entrepreneurs. So reach out early, and let's have a conversation early and often. That's the best way for us to get the ball rolling.
Awesome. And just for me, I mentioned too, LinkedIn is a good place to connect with me. I'm happy to chat through SVB's banking products and just how we work with founders in general. All right, Kurt, I'm calling in your question. So this one is relevant, but it's a little bit unique. So when you need to hire and you're a bootstrapped founder, what level of hire should you start for basic programming? And he's interested in dollar-wise, so I would be curious in hearing your perspective on this.
What I can say so we actually bought an early stage software business last year. And aside from someone that really needs to be product lead, like really innovating the product there's so many outsourced services, onshore and offshore hybrid models that are pretty reasonable. I think for a almost entire product overhaul, we paid like $7,000. It was great quality work. It was a hybrid onshore offshore offering. So I would say if you already have a co-founder who can lead the product vision, then there are definitely a lot of those services out there. But that's one thing you want to vet very carefully. Talk to references ahead of time.
Wonderful. Anything else to add, John and Henry?
Yeah, I mean, I would agree with James' comments. We do have tons of companies that work with outsource, even though they do get tax credits for having employees in Canada or US. Most of the time, they also have an outsourced team as well, right? So I think that's definitely one avenue that I would explore. And we would need to find out more information about the level of company and the programming that is needed, but it does sound like maybe somebody that is not so junior, but a mid-level hire that could maybe lead and build that department as well. I mean, as companies are scaled, the mistake that I see the most when you do a large raise, and that could be, $4 million seed raise, which is pretty large comparing to 5-10 years ago. The mistake of hiring senior people, I see that a lot as a mistake, right? Because I think there's a lot more that can be done with people that had 2-3 relevant experiences prior to that, instead of going for the most senior person in that specific field.
Awesome. This is very aptly timed, Kurt, who asked this question. I just finished a lunch and learn with the founder of this company called Telescoped. I'm going to put them in the chat here. They're awesome. They do remote software engineering. Definitely reach out to them. They are a great option for a bootstrapped company. And 30 seconds, Henry, anything to add?
I was going to echo the same thing that both John and James said as well. At that stage, for the dollar, it might be, for the worth of your dollar, it might be best to look at outsourced options.
Awesome. Great. Well, you know how to connect with us. This has been a lot of fun, and I appreciate the three of you spending some time and talking with me today.
Thank you so much for hosting.
Appreciate it as well.
Thank you, guys. I'm going.
See ya.